You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by my co-host, John McEwen, and it's the 10th of June, 2025. In this week's episode, we'll be discussing AutoTrader, Pets at Home, C&C Group, British Land Co., Hollywood Bowl, and our US company of the week is Nvidia. John, should I start us off with AutoTrader?
Yeah, absolutely. A favourite of the show, but one that neither of us own.
I used to own it, but unfortunately I sold it.
Okay, has it done well since?
I think it has, but I sold it to buy more Rightmove. I used to own both of them.
Okay.
So I've done okay from that.
How is it doing now?
I think it's doing well. The market disagrees with me. Yeah, so they have come out with their full year results, and group revenue was up 5% to 601 million. That was split between AutoTrader revenue, which was up 7% to 564 million, and Autorama, which is the basic kind of AutoTrader, but for finding a lease. One of the brands I've got there is Vanarama. And Autorama segment, that was down 12% to 36 million. So of the 601 million, 36 is Autorama and the other 564 is AutoTrader. For the operating profit, that was up 8%, and that was made up of a 4% increase for AutoTrader to 394 million and a 51% improvement for Autorama. And operating profit margin for regular AutoTrader was down 1% to 70%. And for the group as a whole, it was up 2% to 63%. Basic earnings per share was up 12% to 31.66p a share. And cash generated from operations was up 5% to 399.7 million. They've highlighted that the UK's digital services tax was recognised for the first time with a £10.2 million charge to operating expenses in the year. And retailer revenue grew 7% with the number of retailer forecourts increasing 2% year on year. They remain more than 10x larger than their nearest competitor. Deal Builder, which enables car buyers to value their part exchange, apply for finance and reserve a car, has continued to scale to approximately 2,000 retailers at the end of March, up from 1,100 a year ago. And they generated approximately 49,000 deals throughout the year, which was 3 times more than the previous year. Given this progress, have decided to make Deal Builder functionality part of the core advertising proposition. I believe this will accelerate retailer adoption, car buyer engagement, and monetization. They're continuing to see strong levels of demand for used cars, with a record number of cross-platform visits and minutes spent on AutoTrader. Supplies remain constrained for vehicles aged 3 to 5 years, and the combination of high demand and restricted supply in key age cohorts has led to cars selling at a faster rate than any time in their recent history. 5% increase in number of cars advertised through AutoTrader, and used car pricing has been stable over the last 12 months following declines in the previous financial year. They've said that with the announcement of a UK-US trade deal and the government's plans to soften the zero-emission vehicle mandate, they expect overall new car registration volumes to be well supported over the next 2 to 3 years. They've highlighted that they've returned 275.7 million to shareholders in total, and that is on a market cap of just over 7 billion. And that's made up of 187 million of buybacks and 88 million of dividends. The average number of retailer forecourts in the period increased 2% to just over 14,000, and the average revenue per retailer was up 5% to 2,854 on average. And for Autorama, they delivered 6,268 new lease vehicles, down from 7,847 the year before, and that's continued to be impacted by supply trends in the new car market. They've said for the outlook, they expect retailer growth to be between 5 and 7%. And Autorama losses are expected to reduce in line with current market expectations. And they'd also highlighted that at the beginning of 2011, the average price of a used car advertised on AutoTrader was £9,000, whereas today it's over £17,000, which is a growth rate of over 4% a year. So that's comfortably outpaced inflation, I think. In terms of the valuation, the business trades at a PE of 25 and has a dividend yield of 1.34%, although most of the money returned is in the form of buybacks. And in terms of the share price, the shares didn't react very well to these results. So the business was trading at about £9.20 a share before the results, and it dropped to around £8 a share after. And in terms of the valuation of business now, as I said, the business now trades at a PE of 25. I thought these were a really good set of results. I'm not really sure why the reaction was so negative. I couldn't see anything in the results that I found particularly concerning. There wasn't really anything in the guidance. I did have a look online, see if there was any like negative news or anything that maybe wasn't actually in the results that could have reflected. And I just couldn't see any reason for the reaction. It could have been a valuation thing because it's dropped a decent whack and it's still come down to 25, which for a business growing 5 to 7% a year is expensive, but you are getting a really, really high quality business. And I think it's actually got a decent amount of long-term tailwinds because I think that I just don't see the demand for used cars going away. I think as we transition more and more to net zero and to more electric cars, I'd have thought in the medium term that's probably a benefit for AutoTrader, because my personal opinion would be that the second-hand value of petrol and diesel cars will probably be maintained until the issues with like the batteries and stuff are sorted with the fully electrics and, you know, the depreciation and stuff like that. So yeah, so I thought the results were very good. And I really like it, actually. I just don't know if I'd want to pay 25 times earnings to open a position, but it is a business I really, really like. What about you, John?
Yeah, no, I mean, I agree with you. I thought these were a good set of results. It's rather like the right move for cars. It's got very good profit margins of 63%, and it's got essentially the monopoly on the UK market. I suppose if you looked at it, I mean, purely from a growth perspective, it's maybe slightly more difficult to make the argument for huge growth ahead. But with those sorts of margins and the monopoly, I suppose it doesn't need to grow that much. It is a fairly toppy valuation, and I suspect that's probably more why you saw the share price fall on these results. And if the market had been hoping for higher and then being disappointed, would I buy shares? I don't know. The valuation I find a little bit difficult, but there are far worse businesses you could buy. Probably as I already own Rightmove, I just stick with that. But yeah, it's a great, very high quality business.
Should we move on to another business that's proven itself to be quite high quality in the time we've covered it?
Yes, no, absolutely. And not one that you would expect, but Pets at Home, which was traditionally just pet retailer, and then in the last few years has moved into, become, I guess, a veterinary group also. They had their fourth quarter results out last week with full year revenue flat at £1.5 billion, with a 1.8% decline in retail being offset by 16.8% growth in the vet group. Underlying profit before tax was also flat, landing in line with guidance of £133 million. And cash generation has improved, helping to push free cash flow up by 14.8 million to 83.8 million pounds, and leaving the company with an underlying net cash position of 6.2 million pounds before lease liabilities of 348.3 million pounds. Underlying profit before tax is expected to decline this year to a range of between 115 and 125 million pounds, and a 10% drop in the midpoint, or at the midpoint. The final dividend was unchanged at 8.3 pence a share, and Pets at Home has launched a £25 million share buyback. Shares were down around 2.5%. In terms of valuation, Pets at Home has market cap of just under £1.2 billion and trades at 13.4 times forward earnings, compared to the 10-year average of 15.5, and it has a prospective dividend yield of just over 5%. I thought these results were pretty good. I think it's obviously disappointing with the decline in retail. However, you are seeing their strategy paying off, which was that during the sort of COVID boom that they had, they did go quite heavily into the veterinary market, which was attracting pretty low valuations at the time. And essentially they've hoovered up a large part of that. It was a part of the market that was largely, and historically, if you went back 20 or 30 years, split between many small practices and individual vets owning them, almost a bit like sort of GP surgeries. that trend has reversed massively in the past 10 years, and Pets at Home have taken essentially full advantage of that, going into it in a pretty big way. And you are seeing a logical add-on, and the revenue grow pretty significantly from the veterinary group or the veterinary services part of the business. It's quite interesting on that side of things because it has come into the headlines in the last couple of years, particularly that whether there is any sort of price fixing and monopolistic practices going on there, which I guess is a bit of a concern if your Pets at Home, depending on what the sort of CMA find in that. That being said, I wouldn't assume that we're sort of peak pets, but you had a huge boom, particularly in dog ownership, going back to around the pandemic and people wanting pets during that period. As those pets get older, they are going to have more sort of healthcare or sort of veterinary needs. So you'd actually expect that, I suppose, going forward and in the next couple of years, there to be essentially more veterinary bills for those pets from that boom. And Pets at Home are a logical provider to service that, or service at least part of that. On the retail side of things, whilst there have been sort of some difficult comparative numbers over the past few years with that boom, particularly around sort of COVID and immediately post-pandemic, they have grown their Pets Club membership. So you've had sort of VIP, very important pets, and the membership there grew by 5% last year. So now it's about 8.2 million pets. Very, very valuable source of data, and they can use that for promotional activity for both divisions in terms of retail and also the veterinary side of the business. I think to some degree, you've got a bit of protection from the retail side of the business, even though it is more traditional bricks and mortar, in that it is almost exclusively retail parks, which historically have seemed to have fared better than those sort of town or city centre counterparts. And they seem to integrate much better in the form of click and collect. And I suppose the fact that a lot of owners want to try out the products to some degree. And also, if they want to buy a pet, particularly if it's a small animal, they generally want to go in somewhere physically to see it. It's not kind of an online Amazon type business. So I think it's got those sort of slightly more defensive and resilient factors, even in the retail business. I think some of the projections, yes, they're not fantastic, but it is reflected to a degree in the share price and how the earnings multiple has come back down. I still think there's a good growth ahead, albeit with some clouds, but good growth ahead when it comes to the veterinary division. And overall, for a retailer plus veterinary side at 13.4 times forward earnings, for a business that I do think actually has quality, which isn't often what you'd say of sort of a retailer, is pretty good. And I don't think I'm quite there at buying shares. But again, I think it's one that you could do a lot worse on. Sam, what are your thoughts on these latest set of figures from Pets at Home and the group as a whole?
Similar, I think it's shown in the time we've covered it. It's a really high quality business. The move to the veterinary side just made total sense. And it's working really, really well. Only negative is the underlying profit before tax expected to decline in the current year. But if you take the midpoint of the range they've given, that's 120 million, and that compares to 133 million this year. And when you look at the changes to the national living wage and the national insurance contributions, that's going to increase their cost by about £18 million. So there's a reason for it. They've just not been able to offset that. And I think a lot of business also as well, apparently there was new packaging regulations, so that's added a few million on as well. So about 20 million from new taxes and regulations. And we are seeing that with a lot of other businesses as well. So I think you can't really knock them for that. But in terms of revenue and everything, I think they're doing everything they can. I think that 16.8% growth in the vet group is fantastic. But yeah, I think prospective yield of over 5%, that's really, really good as well. But yeah, I think it's not for me. It's not really at a point where I'd want it in my own portfolio, but I can absolutely see why someone would make an argument for it, like you've said.
Yeah, no, fair enough. Okay then, on to C&C Group. Is it a
Yes.
debut on the show?
It is a debut on the show. So C&C Group is not a company I was familiar with prior to this week. However, you may be familiar with some of their brands. So the brands include Bulmers Cider, Magners Cider, and Tennent's Beer, which is actually the best-selling beer in Scotland. I didn't know that. C&C Group, that's basic. They've got a few other brands, but I've not really heard of the others. Those are the big three. So C&C Group, they are an Irish company, but they're listed on the FTSE 250. They have come out with their full year results for the 12 months ended 28th of February 2025. And revenue was up 13% to 1.6 billion. And all these figures are reported in euros. Adjusted EBITDA was up 18% to 112 million. Operating profit before exceptional items was up 17% to 77 million. Operating margin was up 1% from 3.6 to 4.6%. There's a lot of adjustments in here. Adjusted profit before tax was up 17% to 55.9 million. Basic earnings per share it improved from negative 29 cents to positive 3.5 cents. Free cash flow, excluding exceptions, is down 16.8% to 68.8 million. And net debt excluding leases was up 23% to 80.9 million. And the leverage ratio increased slightly from 0.8 to 0.9x. However, when the net debt is 80.9 million and the operating profit is around 80 million, it's not really at a level anywhere near which you'd be concerned. So Tennent's and Bulmers achieved market share gains and both maintained their market leading positions. Bulmers is the number one selling cider in Ireland, as well as Tennent's being the number one selling beer in Scotland. Magners relaunch is underway with initial off-trade gains, recovering customer momentum. So the strong recovery in the distribution service with levels with 98% on time and 96% in full. So they do distribution for a few other brands, but it's not, those brands aren't really, there's no big ones in there. In terms of the outlook, they think there'll be limited tariff impact on trading and costs. The 150 million capital return program has been maintained. I'll just find out what the adjustments are. So a lot of it's restructuring costs, actually, the adjustments. So they've reorganized the logistics business. So both the branded and the distribution segments recorded higher operating margins. Operating costs decreased by 6.7%. And 53 million euros was returned to shareholders with an additional 15 million buyback started in May 25. They had a pre-tax profit of 19.6 million. That compared to a loss of 111 million the year before. And that was driven by improved trading, lower exceptional items and cost control. And the previous year, the reason that those comparables are so bad was, I'd need to know more about this, but the reason they were so bad was because there was an impairment of the goodwill in relation to the Magners brand in the UK, reflecting lower expected future profits from the brand. And they had an impairment of 125 million euros. I don't know why the Magners brand has been impaired so much. They'll obviously know more than us, but I thought that was a pretty solid brand. So I'm surprised by that. Anyway, in terms of the valuation, the business trades at a forward PE of 16 and has a dividend yield of 3%. I think the results were good, but they were up against quite easy comparatives by the sounds of it. The fact that Magners, which is one of the three key brands, has been impaired by that much in the previous year is concerning. I mean, in terms of Tennent's, I know it might be the best selling beer in Scotland, but I wouldn't be particularly bothered about that as a brand. It doesn't really excite me. Bulmers, I think, is a good brand as well. But I think the issue is it might be a smaller company, but you're still going to have the same problems as when we've covered Heineken or AB InBev, where in terms of the market, volumes are decreasing. And I don't necessarily see any of the brands they've got as being at the more premium Diageo end of the market where they can offset it with price increases. It's like, if Bulmers increase the price, at what point do you just switch to, I'm trying to think of a cider brand now, but some of a generic cider brand.
Henry Weston.
Was Old Moot, for example. I know it's slightly different. Strongbow, you're obviously more of a drinker than me.
I'm not a cider drinker, but these
are Orchard.
Okay.
Copperberg.
Yeah.
Well, Thatcher's.
Yeah.
Well,
fair enough.
But the point is, there's no shortage of cider brands that you can switch to if Magners start increasing the price. That's if you're particularly loyal to Magners in the first place. So I think a lot of the time it's just whatever the place you're ordering at has. I would be concerned about the long-term movements in the market, and I don't think those brands particularly insulate them from that. So it's not really a business I'd be interested in at any price. What about you, John?
Yeah, I mean, my feeling on it is largely as you've outlined. I'd have real concerns going forward because with all of the brands, they're largely UK based and they're reliant on volumes. I think if you see that trend of Gen Z drinking less and therefore volumes dropping, and also if you have more of a health kick in Scotland and, for example, because it's such, or so much orientated towards the sort of UK or British Islands in that, GLP-1s being rolled out, for example, on the NHS, if lots of people in Scotland, for example, are on those too, then you're probably going to see volumes fall. And as you mentioned before with Diageo, I think people can genuinely have a sort of luxury spirit and not necessarily drink it in huge volumes, and Diageo can still do well. Whereas I don't think that can be the case with C&C Group and their brands. I would say on Tennent's, it is. I've lived in Scotland, and it's definitely a staple. It's literally everywhere you go, and I haven't. Well, it won't be on the Celtic and the Rangers shirts for a while because of sort of advertising restrictions. But at one point, it was on both of their shirts.
I think they've got the Scottish national team. They're sponsoring them in some capacity.
Okay, then maybe there's a Tennent Zero that's sponsoring them.
Are you suggesting they use that to get around the advertising?
I would never suggest such a thing. But I do wonder, and I think from an investing perspective, and if you were looking at it in terms of volumes, I just don't see the long-term trend going up for any of those brands. I know maybe short-term and market share increases for Bulmers and Magners, but I think the longer-term trend is definitely against them. And I really can't see the argument that you could make for, say, Diageo and like launching a more premium version of Tennent's, Magners, Bulmers, that they don't lend themselves to that. So, yeah, whilst they're good numbers in these results, I think longer term, I'd see it more as a declining business. And I don't really see them getting around that. If they have zero equivalents, they may already have those. Again, just selling them in the volumes that they're currently selling them, again, I don't see. So for me, it would just be uninvestable.
Should we move on to British Land Co then?
Yes, so British Land Co is one of the largest REITs in the UK. We had covered it a couple of times, and I think we covered it more immediately in the aftermath of the pandemic when it was really struggling. Anyway, it's the first time for a while. They had their full year results out with full year net rental income up 3% on a like-for-like basis to £439 million. Retail and London urban logistics led the way, up 5%, whilst campuses grew by 2%. Underlying profit grew slightly faster at 4% to £279 million, helped by increased fee income and cost discipline. Estimated rental value, ERV, rose 4.9% at the top end of guidance, and occupancy improved from 97.2% to 97.7%, with midweek office utilisation now back to pre-COVID levels. Underlying net debt was up around £400 million to £3.6 billion, reflecting increased investment activity. And that pushed the two important measures of the balance sheet strength, loan to value and net debt to EBITDA toward the top end of target ranges. Underlying profit this year is expected to rise 2%, some way below market forecasts. The annual dividend was held flat at 22.8 pence a share, and shares were down nearly 5% on the results. In terms of valuation, British Land has a market cap of £3.9 billion and trades at 0.65 forward price to book, compared with a 10-year average of 0.71, and it currently has a dividend yield of 5.8%. I thought these results were fair. We haven't covered it for a while. They had obviously had some growth in campuses, and I think the urban logistics with the warehouse spaces, with things like same-day deliveries, and to some degree the retail parks are more interesting. Obviously, this group was incredibly badly hit by COVID, with the office space and retail being smashed. And particularly, with that office space, you're seeing that now 5 years after COVID, getting back for the midweek office utilization to pre-COVID levels. So it's taken 5 years for that. I think for the valuation, it's certainly not expensive. And if you were to make an income and to a degree a value argument for it, there's certainly a lot to be said. However, we're in a very different environment post-COVID. And I think if you're looking at more sort of risk-free return, you can get a relatively decent return on a gilt without taking on any risk. And not that there's any sort of tax advice going on here, but a lot of people who are higher rate taxpayers are getting essentially on short dated gilts 1 or 2 years, perhaps assuming they're a 40% taxpayer, they might be getting 6% of gross equivalent yield, which they're not essentially not taking any risk on. So I think the sort of appeal traditionally since 2008 of some of these retail investment trusts, they have lost a bit of their shine in that with higher interest rates, you can get decent returns in inverted commas without taking any risk at all. In terms of growth, it's tricky. I think it's probably going to be more in those sorts of logistics centres, and I can think of other companies that have more exposure to that, like Segro and like Tritax Big Box. That's probably where I would be looking more, because I think they're on the back of the growth trends. Yes, they're a bit more expensive, but that's probably, if I were going for more of a REIT, where I'd be looking, or potentially Supermarket Income REIT, which is a bit more niche just on the back of supermarkets. It's got an even better dividend. And again, I think arguably a bit safer. And the same you might say for Primary Health Properties, which is a retail investment trust based on GP surgeries. So I think there are better ones out there. And equally, I would probably rather hold the gilt myself than take the risk with British Land Company, quite honestly. Sam, what are your thoughts on British Land? Attractive, not attractive?
Very similar to you. I don't find it particularly attractive. I think the portfolio is all right. It's, like you say, some bits of it just getting back to pre-COVID levels. I think for me, with a REIT, and I think the point you've made about the gilts is a very valid one. And I think for me, buying a REIT, I would either want something where it's a bit more niche and a bit more of like an area where I would see quite decent capital growth in the value of the properties, like a Tritax Big Box REIT, or it's got to be something that has a higher dividend, like a Supermarket Income REIT. But if you're getting the same as a gilt, why take the risk? Because you saw what happened to it at COVID, and that's not going to happen to your gilts. Or it'd have to be really, really bad.
Don't disturb my sleep, Sam.
Yeah,
I'll be tossing and turning tonight.
Yeah, so for me, it's just opportunity cost. It might be a decent REIT, but I think you can get better REITs, and for the yield you're getting, you can get it from a gilt anyway, like you say. So just kind of what's the point, really? So
yeah,
not one I'd be that bothered about. Should we move on to?
Yes, we'll move on. So, how are Hollywood Bowl doing, Sam?
Surprisingly well, actually. So Hollywood Bowl, I'm sure they don't need an introduction. If you're not familiar with what they do, just go to a retail park and there will be one. So they have come out with their interim results for the 6 months ended 31 March. Revenue was up 8.4% to 129.2 million. Group EBITDA was up 2.9% to 49.7 million. And earnings per share was down 11.6% to 12p a share. So total like-for-like revenue grew 2.1%, and that was negatively impacted by 0.9% due to the movement of Easter and 0.2% due to the additional leap year trading day in 2024. UK like-for-like total revenue was up 1.3%, with bowling centres like-for-like up 1.5%. Canada, like-for-like total revenue was up 13.6%, with bowling centres like-for-like up 3.7% on a constant currency basis. They had strong net cash position at March 25 of 22.7 million. They've got an undrawn 25 million revolving credit facility. They've successfully completed a £10 million share buyback, which was equivalent to 2 years of special dividends based on historic payouts. And the interim dividend was up 3% to 4.1p a share. If we break the results down, in the UK, where they had 75 centres at the period end, they are on track to open a record 5 new centres. They also completed 4 refurbishments, and all trading was above the UK target hurdle rate of a 33% return on investment for the 4 refurbishments. In Canada, where they've only got 15 centres, so that's 15 out of 90 in total at the year end, they've said since acquiring our Canadian business in May 2022, it has trebled in size from 5 to 15 centres, with revenue and EBITDA more than tripling over the same period. 2 new Hollywood Bowl-style centres opened in Canatar, Ottawa, and Creekside, Calgary, both trading well and above expectations. 2 refurbishments completed in Meridian, Calgary and Glamorgan, Calgary. They do love their bowling in Calgary. Performing well and receiving excellent feedback, and they're on track to complete 4 refurbishments in the second half of 2025. And the pipeline continues to grow with 3 new locations signed. They've highlighted that in the UK, the spend per game was up 6.3% and 11.6% increase in amusements. And in Canada, 5.4% increase in spend per game and a 10.7% increase in food and drink spend. They've highlighted that for the second half, they have a strong pipeline and they're on track to achieve a target of 130 centres by 2035. So that's an increase of 40 in the next 10 years. So they'll be going from 90 to 130. So it's quite a decent increase. They say they're well insulated from inflationary pressures, with over 70% of revenue not subject to cost of goods inflation. Low labour to revenue ratio of under 20% in the UK, well positioned to mitigate higher employment costs. And they said the recent warm and dry weather, marking the driest spring in over a century, has had a short-term impact on trading over that period. I would highlight the same thing. Doesn't really affect the performance of the business, but now these results contradict it, because it seems the Canada acquisition has gone better than I thought it would have done, and they seem to have much more of an appetite for bowling in Canada than maybe I would have expected, because I assumed it would be like the UK, which I feel is quite saturated, but the Canadian business seems to be doing quite well. That being said, I still think they could be expanding the business in other directions. So I think when you see stuff like Junkyard Golf, or have you come across Roxy Lanes, John?
I haven't, no.
It's some sort of like another quirky, almost millennial bowler, but it's stuff like, like shuffleboard and stuff like that.
Okay, right.
Do you come across shuffleboard?
No.
Shuffleboard's quite good. It's worth checking out. Anyway, Junkyard Golf, that kind of thing, I think would fit very nicely in that portfolio. I think it would give them a bit more growth and something that I think people are actually a bit more excited about. Now, I know business doesn't have to be exciting to make money, but my concern would be that bowling is up against more competition for attention than it was maybe 20 years ago when we were younger. But that being said, the Canada move seems to be going really well. So what do I know? In terms of the valuation, the business trades at a PE of 12.5, and it has a yield of 4.63%. Again, I think when they're talking about the numbers they're looking to hit, and it seems like in Canada there is the opportunity to do that, and with that yield, it seems pretty reasonable. I think I'd still have too many concerns over the saturation of bowling generally and in the UK, but it does actually look like there might be a decent business in there. What do you think, John?
Yeah, no, again, I think you're right. I would wonder how sustainable the trend of bowling is. And I know you mentioned a couple of those other things that I suppose probably directly competing with it. I think that will be my main worry, and that the whole business is just focused on the bowling. There isn't very much diversity in there. And I think that would probably be the reason that I wouldn't sort of be investing. But it does look like they're doing a good job so far in Canada.
Should we move on to a business that seems to be doing a good job with everything they say?
Yeah, absolutely. So is it the world's largest company? It's certainly been up there.
It certainly was the other week.
Okay.
It changes a lot now.
It changes a lot now. So Nvidia, which is, it started off with graphics cards, and now it's a major player, or probably the major player in terms of AI. They had their Q1 results out last week, with first quarter revenue growing 69% to $44.1 billion, despite a $2.5 billion impact related to new export restrictions to China. Data center sales were by far the biggest grower, up 73% to $39.1 billion. Operating income growth was much slower, up 28% to $21.6 billion, as gross margins were dented by $4.5 billion, which was $1 billion less than expected, write-down of that H20 chip inventory that was destined for China. That, however, had no impact on free cash flow, which rose by 75% to $26.1 billion, and the company had a net cash position of $45.2 billion. Nvidia returned $14.3 billion to shareholders over the quarter, mainly via share buybacks. Second quarter revenue is expected to reach around $45 billion, reflecting year-on-year growth of around 50%, despite missing out on $8 billion of future revenue owing to export restrictions. And shares were up around 5% in after-hours trading. In terms of valuation, Nvidia has a market cap of $3.46 trillion and trades at 28 times forward earnings compared with a 10-year average of 36. Pretty incredible numbers, particularly when it's a business of this size. It seems incredibly high quality, but there's a lot I don't know about AI and I suppose about the moat that Nvidia has. It seems to be pretty large, and I suppose how well protected it is in terms of its lead over the competitors there. I guess that is absolutely fundamental to it. I certainly wouldn't be comfortable paying 28 times forward earnings for it. It's huge and the numbers are fantastic, but I don't know whether it can continue. And if there were a challenge to its superiority in terms of the chips and in terms of the AI, what could happen to the share price and the overall valuation there? It could sort of fall off a cliff. I have no idea whether that's going to be is going to happen, but I realise my limitations, and at 28 times forward earnings, I wouldn't be touching it. I'm aware that in my index funds it may form a larger part than I probably should be comfortable with, but I certainly wouldn't go and buy individual shares. Although you just can't fault these numbers. Sam, what's your take on Nvidia and the current valuation?
Yeah, fantastic numbers. Can't fault them. My concern is the valuation, and I know the business keeps going up as I continue to be concerned about it, but I just think a business this size paying 28 times earnings, and then it's a hardware business. It's hard to knock it because the business is so fantastic, but I think a lot of the time if you buy a hardware business for 28 times earnings, it will often end in tears, and that's when it's already the biggest company in the world. So it probably needs to do quite a lot just to justify the current valuation. And then if you want to get a market beating return as well, I just think there's probably easier ways to do it. But fantastic business. But I just wouldn't. I mean, I'd struggle paying 28 times earnings for a software business. But although if it was putting up these kind of numbers, I'd probably be able to. But yeah, it's just with hardware. I think the issue is, if things go badly or whatever, or it can switch off very quickly. That's my concern with it. But it might be in a position where it's going to dominate AI for the next 10, 15 years. And if it does that, it might actually be quite cheap. But I just wouldn't be comfortable taking the risk at that valuation.
Fine. Of the companies this week then, what would be your top pick and what would come last?
So top pick, I think I'd have to go with AutoTrader, but with an honourable mention to Hollywood Bowl, actually. Bottom, I'd probably go C&C Group, actually. What about you?
Top pick, I'd probably go for Pets at Home, actually. I think the dividend's making it more attractive there. I do like AutoTrader a lot, but it is that bit more pricey. In terms of bottom pick, it would be quite easy, C&C. I think for the reasons discussed earlier, I think it's likely in the next 10, 15 years to be essentially a business in decline, in structural decline.
I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.